8 minus 325 is 475. So that would be the debit for this spread. All right, buying the 335, selling the 315. I'm sorry, the 350. Now that's a $15 wide spread. If the stock were to go above 350 and close there on expiration, that spread would be worth 15. We are paying $4.75 for it in this example. Right click. Let's analyze that one as well and put it in here. Now I'm going to uncheck the single option and take a quick look at this one. Now, John, this is quite a bit different, obviously, than the long call. And we can see here's the stock now, where it breaks even. And of course, John, where it reaches its maximum gain, that's around 350. So in terms of max loss, well, that's easy. We just go down here and take a look at the spread, and it says 475. That's 475 times 100. That's $475. Or you could look at this max loss area here and look at the blue number right here. That's 475. I'm going to uncheck that, put in the single option, and that's $8, as you can see. And if we move into the sort of the blade of the hockey stick, you can see the blue number here, minus 800. So no question about that one, John. Greater max loss, potential max loss on the call, 800 versus the spread, 475. All right, let's go to number 2 on the comparison list. What about break-even points, John?
Yeah, this is probably where things may be a little surprising for people that are new with options as we compare the long call and the vertical spread, Scott. So to compare a long single call to a long vertical spread, we can use, well, as we go ahead and look at those break-even points, is the choice that has the highest probability of being profitable. To do this, we need to determine the break-even of each and see which strategy requires the smallest move to generate some degree of profit on expiration. Of course, the smaller the move has a higher probability of occurring than actually the larger move, Scott.
Got it. Well, let's jump back to the comparison chart and look at the break even. Now, that's the good thing about Thinkorswim is it shows you a little hashtag there where that blue line crosses the break even point. And right now we're looking at the call, and that breaks even at 434. That's right here. That's the strike price. 335 plus the $8, that's 343 right there. Now, I'm going to uncheck that. Let's put in the spread. The break even on the spread is just below 340. So again, $3.25 lower or closer, if you will, to the current stock price, meaning it doesn't need to move as far to move into the profit zone of the spread as it does to move in the profit zone of the individual call. So John, so far, first two comparisons go to the spread over the individual option. Let's look at the last one, and that's the maximum gain if it gets to our target. Now, our target we used in this one is about 350. So let's compare and say the stock actually got up to 350, John.
Yeah, so if we're talking about an expectation of price moving to 350, here we can determine which strategy choice profits the most if the underlying stock gets to that identified target price. So for example, we can choose that target price that you mentioned, 350, using probability in the money to help determine a price level that the stock might reasonably get to.
All right, well, let's check this up. Go back to the charts and check it out. Let's go up to the 350 level. Now, quite simply, I just move my cursor over 350 and then look at the blue number right here. So if it goes to 350, it says it's a gain of about $700 on the individual call. All right, I'm going to uncheck the single option and go to the vertical spread. Let's go to 350 and see what the gain there. 1,025, John. That's significantly higher than the 700 for the individual option. So, John, we've looked at 3 different comparisons, back to back, side by side, and it looks like the vertical spread in this case of the stock going to 350 has worked out on all 3 cases. So let's wrap it up. We have just 1 minute, John. What's your takeaway here?
Sure, right. So as we consider these 3 criteria, the call spread does provide a compelling case for us, Scott. So it's important to remember that if the underlying stock were to make a larger move to the upside, at some point, the single long call would become more profitable than the long spread. However, we always consider probability than the long spread. However, we'll always consider probability on your first trade trader checklist and understand in the long run, we would prefer having probability on our side, Scott.
All right, John. Well, the probability of getting to 350 was only about 20%. So
That's right.
This is a good exercise. Well, John, we have to wrap it up there. I think you made the point that when you compare the three side by side, you're right. A compelling case could be made for the vertical spread over the long call in this situation. Well, John, we got to wrap it up there. Thanks again for joining us. That's going to do it for us here today, folks. Don't forget, we're back tomorrow to follow up on our example trade on Broadcom and look for others to finish out the week. We look forward.